Franklin India Monthly Income Plan. There are two ways in which investors can diversify across asset classes like equity, debt, and gold when they invest through mutual funds. 1. Choose and invest in individual funds in the proportion of asset classes matching one's risk appetite. For example, higher equity allocation for if one has a higher risk appetite. Or 2. Invest in a mutual fund which offers a combination of asset classes in a single fund. For example, a single fund which invests 60% of the money in equity assets or 40% of the money in debt assets or vice versa. Such funds are called hybrid funds. In this video, we look at hybrid funds which offer a ready-made diversified asset allocation combination to investors, thus avoiding the hassles of rebalancing asset classes on their own. Hybrid funds offer different asset classes either as a portfolio of stocks or securities, or as multiple funds within a fund called a fund of funds product in the stated proportion of asset classes. Why invest in hybrid funds? Financial prudence advocates that an investor must invest across asset classes to achieve diversification. This can be done via asset allocation. Diversification helps lower the risk in a portfolio, as no two asset classes generally move up or down at the same time, and this in turn aims to provide higher risk-adjusted returns. Asset allocation in a hybrid mutual fund moves as per the mandate mentioned in the offer document. One can allocate across equity and debt mutual funds manually, but this requires one to regularly monitor the allocation and rebalance it periodically to the original asset allocation. For example, if the asset allocation was a 60-40 debt-equity mix and it changes to 70-30 after 1 year due to market movement, one needs to sell debt or buy more of equity to bring the ratio back to 60-40. This is called rebalancing. While rebalancing across individual mutual funds, it is also important to check for exit loads and tax implications in case of redemptions. However, in case of hybrid funds, there is no impact of exit load and tax when the fund manager rebalances the allocation. Hybrid funds offer a ready-made asset allocation combination wherein one can either choose A. A static or range-bound asset allocation, like a balanced fund which has a higher allocation to equity, or a monthly income plan which has a higher allocation to debt. Or B. A dynamic or a variable asset allocation, which uses a formula or strategy like say price-to-earning ratio to allocate across asset classes. These funds swing between an equity orientation to a debt orientation depending upon the value of the formula. Why does a combination of asset classes work? In this table, you will realize that the same asset class does not always give the best returns. Sometimes it is equity, sometimes gold, and sometimes debt. However, it is difficult to predict which asset class will do well year on year. One needs to therefore invest in a combination of all asset classes to reduce the risk of underperformance in one asset class. As per this table, a combined or a hybrid portfolio may not have provided the best returns, but has also not provided the worst returns and has stayed on a middle path. A hybrid fund thus helps to follow the middle path. Key benefits of investing in the Franklin India Monthly Income Plan. This is an open-ended fund that seeks to provide regular income by investing predominantly in fixed income with up to 20% in equities. The equity component is invested in a diversified portfolio of predominantly large-sized companies. For investors who are not comfortable with taking a higher equity exposure, this fund provides the opportunity to take a tactical exposure of up to 20% in equities, which acts as a growth driver to the predominantly fixed income-dominated portfolio. As an investor, it helps you strike a balance between growth and stability by maintaining a diversified portfolio of fixed income component to act as a cushion to the relatively more volatile equity component. Ideal investment horizon. Since the Franklin India Monthly Income Plan is a fixed income-oriented fund, we recommend an investment horizon of 3 years or more. Every investment you make must ideally be linked to a financial goal, and this goal could be of varied durations depending upon your investment needs. Since the Franklin India Monthly Income Plan has up to 20% allocation of equities with a balance in fixed income, the scheme is well suited for short-term investment goals where an investor is primarily seeking income but is also comfortable with taking some equity exposure that could act as a growth driver to the portfolio. Who should invest in this fund? This fund is a great option for investors with a moderate risk profile and are primarily seeking regular income with moderate growth potential. Income is not assured and is subject to availability of distributable surplus. Investors looking to invest in a fixed deposit with an investment horizon of 3 to 5 years could consider this fund as an alternative investment option. Let's take a look at the tax structure. Liquidity. You can redeem your investments in full or in part on any business day. The redemption amount is normally dispatched within 10 working days from the date of redemption. You could either receive this amount as a direct credit into your registered bank account or as a physical check which you can deposit into your registered bank account. Let's get to know some fun facts of the Franklin India Monthly Income Plan. For more information, please feel free to contact your mutual fund distributor or registered investment advisor or log on to www.franklintempletonindia.com. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.